Welcome back to The Explainer. Today, we're diving straight into some absolutely fascinating analysis from veteran market analyst Michael Oliver. His thesis is wild, but the data backs it up. He's looking at a deep, hidden sickness lurking right beneath our seemingly robust financial markets. But at the exact same time, he's spotting a historic, explosive opportunity building up in gold and mining stocks. We're going to look at the hard data, examine the hidden spread relationships, and uncover exactly what those headline numbers are masking.
Okay, let's dive into this. Right now, if you just glance at the mainstream financial news, you see headline indexes like the S&P 500 dancing near record highs. I mean, on the surface, everything looks perfectly healthy, right? But what if I told you the actual foundation of economic expansion is completely eroding right underneath those highs? We really need to talk about what the stock market is quietly hiding from you.
Section 1. Beneath the market's surface. The sickness hiding in plain sight. We're going to start by looking at the true engine of the economy, the financial sector. Consider this stark divergence. On one hand, you've got this quote-unquote healthy S&P 500, which is really just propped up by a few heavy hitters, giving off the total illusion of a broad market boom. But on the other hand, you have what we can only call sick financials. Large financial institutions, banks, credit card companies, asset managers, they are quietly struggling. Just look at giants like Visa and MasterCard. They've actually been trending steadily lower. The KBE Bank ETF, which tracks the big banks, took a massive hit in 2022. And today, it's barely scraping above its 2021 peak. Even asset managers like BlackRock are either breaking their long-term momentum structures or teetering right on the edge of it. The market confidence here is getting incredibly selective, and frankly, that's a massive red flag. And this brilliantly illustrates the severity of the problem. When we look at the relative value relationship, or the spread, between the XLF financial ETF and the broad S&P 500, it has literally collapsed. During the bull market years from 2009 to today, the spread got knocked straight to the floor. Financials just keep losing value compared to the broader market, and recent readings have actually broken below prior multi-decade lows. You won't see mainstream headlines about this, but it's a constant, quiet sickness right at the foundation of our credit system. And believe it or not, beyond the banking sector, there's an even bigger elephant in the room.
Section 2. The sovereign debt threat. The looming bond crisis.
Nations around the globe have racked up enormous borrowing obligations, and rising interest costs are putting immense, crushing pressure on public finances. Just recently, JP Morgan CEO Jamie Dimon issued this incredibly stark warning. He said, "We're facing a government bond crisis we're going to have to deal with not 10 years from now." The bond markets are already starting to reflect these exact concerns. Investors are demanding higher compensation just to lend to governments, and it's creating a mathematically inevitable threat to the entire system. Now, when bond markets face this level of instability, central banks have to step in. And it's really important we look at this impartially, totally stripping away the politics. Whether you lean left or right, the reality is that the Federal Reserve doesn't actually shape reality, they react to it. They cause the booms that create the busts, and when the bubble finally breaks, they're forced to chase events. To stabilize this looming debt crisis, the Fed is going to have no choice but to defend the house from burning down, as Oliver puts it. They will intervene with massive liquidity programs. They're going to print. And while that might stabilize markets for a minute, it raises profound questions about long-term currency stability and, more importantly, your purchasing power. So how do we protect that purchasing power?
Section 3. Gold's historic bull runs. A look at the numbers. Let's see how hard assets actually respond when the broader stock market, which is currently dancing on glass levels, faces major downside. If we throw gold on a logarithmic scale going all the way back to the 1970s, we see a fascinating pattern during periods of economic uncertainty and inflation. First, after a pullback in the mid-70s, gold surged from $100 up to $850. Then, after moving sideways for a decade or so, we had the 2001 to 2011 cycle, where it surged from around $260 all the way up to $1,920. And finally, we arrive at our present bull cycle. Notice a trend in those historical numbers? In both the 1970s and the 2000s bull markets, physical gold generated a staggering eightfold or 8x gain in price. We're talking explosive, parabolic moves fueled entirely by financial instability. Now, what's really interesting about this slide is the comparison to where we are right now. In our current market cycle, gold has only seen about a fourfold gain from its bear low. It's only moved half as much on a percentage basis as those two prior bull markets. Yet, as we just saw with the banking sickness and the sovereign debt threat, the fundamental and technical pressures existing today are way more enormous than they were in those past eras.
So the data strongly suggests this current cycle is nowhere near reaching its extreme.
Section 4, the mining stock dynamite, the ultimate hidden opportunity.
But hey, if physical gold has room to run, there's another asset class entirely that is prepping for launch. To understand why this sector is literally a stick of dynamite waiting to explode, we have to look at something called the spread. It's a simple but incredibly revealing metric. We take the price of a mining index, like the GDX or the AZO, and we divide it by the price of an ounce of physical gold. This gives us the miner's relative value. It tells us exactly how the companies doing the hard physical work of digging the metal out of the ground are being valued compared to the metal itself. If you go back and look at the XAU index spread through the 1980s and the 1990s, you'll see a very clear, highly reliable midline. For decades, the value of the mining index oscillated right around 26% of the price of an ounce of gold. It bounced a little higher, maybe dip a little lower, but 26% was home base. That was just how the market historically valued these miners.
But check out what happened next. By the time we hit the bear market low in 2015, that exact same spread had collapsed to an absolutely staggering 4%. No joke, it dropped from a historic mean of 26%, with highs up to 35%, down to just 4%. So the crucial point is this. These are the companies physically getting the metal out of the ground. They didn't go to zero. Instead, since that 2015 low, the miners have spent a decade building this massive base range, and they've approached the top of that range 3 times now. When you realize the historical mean is 26%, and we're currently sitting near the absolute floor, it becomes obvious that buying miners today represents the ultimate definition of buying low before a historic breakout. When this range finally breaks, Oliver argues these miners are just gonna explode.
And we actually have historical precedent for this kind of wild divergence. Think back to the Great Crash. From 1929 to 1932, the broader stock market collapsed by 80%. But during that exact same window of profound economic terror, a company called Homestake Mining soared by 1,000%. It's crazy to think about, but during major bear markets in stocks, gold and the companies that mine it historically become massive beneficiaries.
Let's quickly summarize the core catalysts here. Why are miners poised to explode? First, they're severely undervalued relative to physical gold, as we just saw with the spread. Second, as gold pushes to new highs, the miners are seeing improving fundamentals, way stronger cash flows, and expanding profit margins. Third, their technical momentum is teetering right on the cusp of breaking out of a decade-long range. And finally, public psychology. When those bad financial headlines about government debt and banking stress finally break through to the mainstream, the public is going to panic. And when they realize they need to be in hard assets, they're going to chase these mining stocks like a wet bar of soap.
So we've seen that the broad market is effectively dancing on glass, while an entirely ignored sector is wound up like a stick of dynamite. Every major financial cycle eventually reaches a turning point, where the underlying weaknesses just become impossible to ignore. So I want to leave you with this final critical question as you consider your own asset allocation. When those financial headlines finally break, will your portfolio be holding the glass or the dynamite? Thank you so much for joining me for this explainer. Keep learning, stay curious, and I'll see you next time.